Most people think reaching $10 million is mainly an income problem. Earn more, get promoted, save harder. But 8 figures usually require a different engine because $10 million is not really an income target. It is an ownership target. You do not get there by collecting $10 million in paychecks. You get there by owning assets, businesses, and systems that can grow without demanding an equal increase in your time. In this video, I'm going to map that path using what I call the 3-pillar equity growth model. Pillar 1 creates surplus cash. Pillar 2 turns that cash into productive assets. Pillar 3 increases the value of those assets and converts part of that value into liquidity. This is not a guaranteed formula. It is a framework for understanding how large-scale wealth is built, so you can identify which part of the machine you need to work on next. And it starts with the limitation of earned income. Why earned income eventually hits a ceiling? A high salary is useful. It gives you stability and investable cash. But it has 4 limits. The first is tax. As your income rises, the amount you keep does not always rise at the same speed. The second is lifestyle inflation. A better home, a better car, more expensive travel. You can look wealthier while owning very little that actually produces money. The third is inflation. Cash is necessary for safety, but it slowly loses purchasing power and cannot be your only growth engine. The fourth limit is time. A salary depends on your continued participation. You still have to show up, perform, and remain valuable to someone else's system. Here is the basic math. If you saved $100,000 every year and earned no return, reaching $10 million would take 100 years. Even with strong long-term investment returns, the journey would still require decades of unusually high saving. That is not a bad plan. It is simply a slow one. So the goal is not to reject earned income. The goal is to use it as fuel. First, you work for money. Then you use that money to buy ownership. Eventually, that ownership begins producing more value than your labor alone could create. That shift is the foundation of the model. Pillar 1. Build a strategic cash flow engine. Before you can acquire serious equity, you need surplus capital. For most people, that surplus will initially come from work, a business, or a high-margin offer. The key word is surplus. Revenue is not enough. A business can generate $1 million in sales and leave almost nothing for the owner. Another can generate far less revenue, but retain much more profit. So Pillar 1 is not simply about making more money. It is about building a cash flow engine that produces money you can keep and redeploy. A strong engine has 4 characteristics. First, healthy margins. After paying for delivery, software, contractors, marketing, and overhead, a meaningful percentage remains. Second, recurring demand, retainers, subscriptions, repeat purchases, maintenance, licensing, or any model where customers naturally return. Third, scalability. If every extra dollar of revenue requires almost $1 extra of labor or equipment, growth becomes expensive. A stronger engine uses systems, distribution, intellectual property, automation, or software to serve more customers without costs rising at the same speed. Fourth, lower dependence on you. A business that stops when you stop is still mainly a job. The objective is to document delivery, automate repetitive work, delegate lower-value tasks, and build a predictable way to attract and retain customers. AI can help here, but only when it improves the economics. If it reduces production time, improves support, speeds up research, or removes repetitive admin, it can increase margins. Once the engine becomes profitable, you need a clear order for the cash. Reserve money for taxes. Build an operating buffer. Reinvest in parts of the business that already show a measurable return. Pay yourself enough to maintain a stable life. Then move part of the remaining surplus into assets outside the business. That last step matters. Many owners keep every dollar inside the same company because it feels familiar. Their income grows, but their entire net worth remains tied to one business, one industry, and often one platform. Pillar 1 should finance Pillar 2. It should not trap all your wealth in one place. You are ready to move forward when your personal expenses are covered, the business has a reasonable reserve, and the surplus appears consistently. Pillar 2. Convert cash into productive equity. You take the surplus from Pillar 1 and exchange it for ownership. Every asset should have a clear job. Some provide liquidity, some compound over time, some generate current cash flow. A smaller group may offer higher upside with higher risk. For simplicity, think about 3 asset groups. The first is liquid market ownership, diversified funds, and public companies. These assets let you participate in economic growth without operating the businesses yourself. They are relatively easy to buy, sell, and measure. The second group is real estate and other tangible cash flow assets. Real estate can provide rent, appreciation, and access to leverage. But a property is not automatically a good investment. It must be judged like a business. If it only works when everything goes perfectly, it is fragile. The third group is private or digital equity. That may include ownership in a private company, software, intellectual property, licensing rights, a digital product, or a media asset. These assets can scale quickly, but they are harder to value and sell. The upside may be greater because the uncertainty is greater. The goal is not to collect exciting assets. It is to build a portfolio where no single mistake can destroy the plan. That means controlling 4 risks: concentration risk, too much wealth tied to one asset, company, sector, or platform; liquidity risk, owning something valuable that cannot be sold when cash is needed; leverage risk, using debt that only works if income and prices keep rising; and complexity risk, owning more things than you can properly understand or manage. A strong portfolio should be diversified, but it should also be understandable. Now here is the compounding loop. Your cash flow engine produces retained profit. Part of that profit moves into productive assets. Those assets generate income, appreciation, or both. The income is reinvested. Over time, more of your yearly progress comes from the assets and less from new labor. At first, your contributions do almost all the work. Later, the portfolio's annual growth may become larger than the amount you add. Eventually, your assets may create more value each year than your active income. That is when the system starts carrying itself. To track this clearly, separate your net worth into 3 categories: liquid assets, cash and investments you can access quickly; productive equity, businesses, property equity, market investments, and other assets designed to produce income or growth; personal use assets, your home, vehicles, and possessions. Personal use assets may have value, but they should not be confused with productive capital. You should also track your equity conversion rate, the percentage of your after-tax income that becomes productive assets. If your income rises, but this rate stays near 0, your lifestyle is growing faster than your ownership. Income gets attention. The conversion rate determines how quickly income becomes wealth. You do not need to avoid enjoying your money. You need a deliberate gap between what you earn and what you consume. That gap becomes equity. But if the target is $10 million, gradual accumulation may still take a very long time. At some point, you may need a major increase in the value of an asset you own. That is the role of Pillar 3. Pillar 3. Build for a liquidity event. A liquidity event is when concentrated ownership becomes usable capital. It could mean selling a business, selling part of one, refinancing a property portfolio, bringing in an investor, or selling a digital asset. The important point is that strong exits are built years before they happen. A buyer does not pay for how hard you worked. A buyer pays for future cash flow, strategic value, and the ability to operate the asset after you step away. That usually requires 6 things: predictable revenue, strong customer retention, healthy margins, low founder dependence, clean financial reporting, and some form of defensibility, such as proprietary data, intellectual property, contracts, brand trust, distribution, switching costs, or technology that competitors cannot easily copy. Customer concentration matters too. If one client produces half the revenue, the business may look strong until that client leaves. The deeper principle is transferability. Could another competent operator understand the system? Could they continue serving customers? Would revenue remain stable without you? Could they see clear opportunities to grow? If the answer is no, you may own a profitable income source, but not yet a highly valuable asset. A liquidity event also does not have to mean selling everything. You might sell a minority stake. You might sell the company, but keep some equity. You might bring in an operator and continue receiving distributions. Or you might refinance a property portfolio and release part of the accumulated equity. The purpose is the same: convert part of a concentrated asset into capital that can be diversified. That can create a major jump in net worth, but it also creates a new risk. After a large exit, it is easy to treat the money like a reward. A better way to see it is that the exit changes the structure of your wealth. You are moving from one concentrated asset into a broader portfolio. Some capital may stay liquid. Some may move into diversified market assets. Some may go into income-producing real estate. A smaller portion may fund future entrepreneurial opportunities. The exact structure requires professional tax, legal, and financial advice. But the principle is simple. A liquidity event should reduce concentration while preserving the productive power of the capital. It should not simply finance consumption. The roadmap from $0 to $10 million. Now let's place the three pillars into one sequence. Stage 1 is financial stability. Build an emergency fund, remove dangerous debt, understand your spending, and create a basic investing habit. The goal is not maximum return. It is making sure one emergency cannot wipe out your progress. Stage 2 is cash flow expansion. Increase your earning power or build one reliable business engine. Do not chase 5 weak income streams. Focus on one system that can create consistent surplus. Stage 3 is systematic asset accumulation. Automatically move part of that surplus into productive assets. Maintain liquidity, diversify gradually, and avoid using debt simply to look like you are progressing faster. Stage 4 is asset scaling. Identify which assets can grow without needing the same increase in your time. That may mean adding recurring revenue, buying more market equity, expanding a property portfolio, or building scalable digital assets. Stage 5 is exit preparation. Clean up reporting. Reduce dependence on you. Strengthen recurring revenue. Document operations. Build something another owner could actually take over. Stage 6 is liquidity and diversification. Convert part of the concentrated equity into usable capital, manage taxes carefully, and rebuild the portfolio around long-term growth, income, and resilience. These stages will not always happen in a perfect order. Pillar 1 may continue growing while you build Pillar 2. Pillar 2 may help finance a new business. Pillar 3 may happen more than once. The model is a cycle. Cash flow buys equity. Equity creates more cash flow. Valuable assets create liquidity. Liquidity funds new ownership. Each cycle can operate at a larger scale than the one before it. Your equity audit. To identify your next move, ask yourself, how much money do you retain each year after taxes and living costs? How much of that becomes productive equity? What percentage of your net worth depends on one asset? How many months could you operate without new income? Which assets produce cash flow and which depend only on future price increases? How much of your business still depends on your personal time? Could another operator understand and run the system? And what is the weakest link right now? Income, margin, spending, asset selection, concentration, or founder dependence? Do not try to fix all 3 pillars at once. Your first action is to create a one-page equity map. List your liquid assets, productive assets, personal use assets, and debts. Then calculate 2 numbers, your total productive equity and your annual equity conversion rate. Those numbers tell you where you are and how quickly you are moving. $10 million is an ambitious target. There will be bad investments, changing markets, mistakes, and periods when progress feels slow. But the structure works at every level. Create surplus. Convert surplus into ownership. Increase the value and transferability of what you own. Then use liquidity events to diversify and repeat the process at a larger scale. Your salary may start the journey, but ownership is what eventually has to carry it.